Let's discuss how the accounting differs for a stock dividend versus a stock split. So in each case, the number of shares outstanding is going to go up. For example, if you had a 2-for-1 stock split or if you had a 100% stock dividend, in each case, it's going to double the number of shares. So a stock split, stock dividend, they're both going to increase the number of shares outstanding, but beyond that, there's a lot of differences. For example, with a stock split, you don't have any journal entry, so there's nothing to record into the financial records. However, you need to note that it's going to decrease the par value per share. So here's an example. So let's say we had a 2-for-1 split. Again, 2-for-1 split means if a typical shareholder, let's say they have 100 shares, after the split, they have 200 shares. Okay, so let's say that before the split, the common stock account, so this is the equity section of the balance sheet, common stock was $200,000. We had 100,000 shares at $2 par value per share, so 100,000 times $2, we had 200,000. Okay, so that's our common stock, and then we have retained earnings of $75,000. Now, after the 2-for-1 split, common stock is still 200,000. Okay, that has not changed. And retained earnings is still 75,000. That has not changed. So total equity is unaffected. There's no journal entry required. However, okay, we doubled the number of shares, so now we have 200,000 shares instead of 100,000 shares, and so we've cut the par value in half. Instead of it being $2 par value per share, now it's $1 par value. But the financial statements are unaffected by this because whereas before you had 100,000 shares times $2 par is 200,000, now you have double the amount of shares times half the par value equaling 200,000. Okay, so that's why you don't need a journal entry. You just need to adjust, make a note that the par value has come down. Now, with a stock dividend, the par value per share is not going to change, so we're not going to have this $2 to $1. That's not going to change. The par value per share is going to remain constant, and we are going to have a journal entry. Now, the nature of that journal entry is going to depend on whether it's considered to be a large stock dividend or a small stock dividend. Basically, if we do a large stock dividend, we're going to use the par value per share to do our calculations for the journal entry. If it's a small stock dividend, we're going to use the fair value of the company's stock price. I'll show you that in a second. And in each case, the common stock account is going to increase. Okay, common stock is going to go up. Again, with the stock split, common stock did not change. Okay, the par value per share went down, but common stock remained constant. We didn't even need a journal entry. So let's say we've got a small stock dividend, and by small, I mean less than 20 to 25% of the shares outstanding is the amount of the stock dividend. Okay, so in this case, so here's an example. Let's say Metaverse Plumbing, they have 100,000 shares outstanding before the stock dividend, okay, and they were $2 par value per share. The fair value of the shares are $30 per share before the stock dividend. The company issues a 5% stock dividend. Now, this is going to count as a small stock dividend, okay, 5% stock dividend. We had 100,000 shares outstanding, so that basically means the people who are out there right now, they own shares, they're going to get 5,000 shares, okay? That'll be spread among the existing shareholders, okay, on a pro rata basis. So basically, we're going from 100,000 shares outstanding to there's going to be 105,000 shares out there floating around, okay? So that's what we mean when we say it's a 5% stock dividend. That's less than 20 to 25% of the shares outstanding, so it's a small stock dividend. That means this fair value here of the stock before the dividend, so that's going to be relevant. We're going to use that $30. Now, here's what we're going to do in terms of the journal entries. At the date of declaration, so this is when the company declares the dividend, okay? So when they declare it, we're going to debit the retained earnings account, okay? And then we're going to credit this common stock dividend distributable. Okay, this is a temporary account. We're going to end up zeroing it out. And when we distribute the dividend, we're going to credit common stock. So ultimately, what is ultimately happening is we're going to reduce retained earnings, and then we're going to increase common stock. But we're also going to increase additional paid-in capital. So let me just get to the calculation. I'm getting a little ahead of myself here. So we've got $30 a share is the fair market value of this stock. That's the share price prior to the stock dividend, okay? And then the number of new shares is 5,000. So 5,000 new shares at $30 market value per share is 150,000. That's the amount by which we're going to reduce the company's retained earnings. So this is 5,000 shares times $30 market value, the fair value per share, okay? Now, when it comes to crediting the amount that ultimately we're going to increase common stock, okay, and we've got this temporary account here, we are going to do that. That's going to be the 5,000 shares, but times that $2 par value. Okay, so common stock is ultimately going to go up by the par value times the number of new shares. So that's 10,000. Remember I said the par value per share does not change with a stock dividend. It does with a stock split. So we've got $2 per share, 5,000 new shares, so 10,000. So common stock dividend distributable is going to be credited for 10,000. And then later, when we actually make the company makes the distribution, it's going to zero out that dividend distributable account, and it's going to credit common stock. Okay, so common stock's ultimately going to go up by the par value per share by the number of new shares. Multiply those two. Okay, now the remaining amount, so you got 150 of debits and 10,000 in credits, so you obviously need 140,000 our credit here. That's going to be credited to additional paid-in capital. Okay, so this is the set of journal entries for. So we've got the date of when the dividend is the stock dividend has been declared, and then here is the date of distribution. So ultimate effect: retained earnings goes down, additional paid-in capital goes up, common stock goes up. Okay, so again, common stock is changing, whereas the total amount of common stock, we didn't make a journal entry with a stock split, but here we have a journal entry. Common stock is actually going up. Basically, if you think of the effect of this, we have like shifted the amounts from retained earnings to common stock and additional paid-in capital. Okay, so that's what happened here. Now, let's say that we have a large stock dividend. Okay, we have a large stock dividend, so more than 20 to 25% of the shares outstanding. Let's say it's a 100% stock dividend. Okay, it's 100%. So there's 100,000 shares outstanding before the stock dividend, $2 par value per share, and shareholders are going to receive 100,000 shares. So basically, there's 100,000 shares outstanding. Now there's going to be additional 100,000 shares for 200,000 total. Okay, now when it's a large stock dividend, we don't need to worry about the market value of the share price. Okay, so we don't have to worry about the fair value of the company's stock. We're not going to deal with that. We're just going to worry about this par value. Okay, so the number of new shares, which is 100,000 in this case, times the par value is 200,000. Okay, so we are going to debit retained earnings, although some companies do not debit retained earnings. I should have you know, some companies will debit additional paid-in capital. So just let you know, there's a little bit of diversity in practice here. You can either debit retained earnings or additional paid-in capital, okay, for $200,000. And then again, we're going to credit this common stock dividend distributable for $200,000. That's just a temporary account because we've declared the dividends, but we have not paid them yet. Okay. Now, on the date of distribution, when the company actually gives out that stock, then they're going to debit and zero out that common stock dividend distributable. Okay, debit that zeroes out, and then they're going to credit the common stock account for $200,000. And again, that's just the par value times the number of new shares. Now, again, notice the common stock account is going up. In that account, common stock, the total amount of common stock was unaffected under a stock split, but it goes up under a stock dividend.